crypto funds is changing its capital setup, and that can reshape how the market prices risk. The headline amount gets attention first, but the structure behind it decides whether the move is actually durable. 1.4B flows crypto is the search phrase that fits this story because digital asset investment products just posted one of their strongest weekly inflow prints since early January, led by Bitcoin and a rebound in Ethereum demand. That matters for equity holders, product investors, or treasury managers because the structure behind the capital can be more important than the headline amount. The real problem is that headline capital looks bullish until the market studies cost, timing, and execution risk. Start with the mechanism. Flow data matters because it measures real product demand through listed vehicles, not just exchange chatter. It is a credibility and access signal more than a short-term price guarantee. In plain English, the number in the headline matters because it changes how capital is raised, how exposure is accessed, or how investors judge risk. For investors, the simple translation is this: capital structure can either widen strategic options or lock a company into a narrower path. That is why a move like this can look exciting on the surface and still carry far more risk once you ask who is actually providing the liquidity, the capital, the legal cover, or the operational support. The context matters too. Bitcoin drew the largest share, Ethereum logged its best weekly results since January, and US products dominated regional activity. That backdrop is important because institutional stories usually need repeated confirmation, not one headline, to become durable. Repeated confirmation is how capital stories move from interesting to investable. For people searching 1.4B flows crypto, that bigger backdrop is useful because it explains why this story landed now instead of last month. But context is not the same thing as proof. Here is the split between what is firm and what still needs more evidence. Digital asset investment products just posted one of their strongest weekly inflow prints since early January, led by Bitcoin and a rebound in Ethereum demand. The soft spot is that weekend geopolitical headlines already interrupted the de-escalation story, which means the same macro catalyst that helped flows can also reverse sentiment. That is the line between a capital event that strengthens the story and one that merely postpones a harder question. Viewers can easily mistake a live headline, a chart move, or a product announcement for a complete answer when it may only be the first visible piece. So who feels this first? That matters for equity holders, product investors, or treasury managers because the structure behind the capital can be more important than the headline amount. In practical terms, the market is now being asked to price not only the headline event, but also the follow-through. Execution risk, adoption risk, liquidity quality, legal clarity, or recovery credibility, depending on how the next few sessions unfold. If the follow-through is weak, the market can turn from applauding the headline to questioning the burden that comes with it. That is where investors decide whether the structure strengthens the strategy or simply stretches the timeline. The next follow-through signal to watch is this. Watch whether flows stay positive for a fourth week and whether Bitcoin can hold above its breakout zone when headlines turn noisy again. For this video, the most useful close is a concrete one. Watch whether flows stay positive for a fourth week and whether Bitcoin can hold above its breakout zone when headlines turn noisy again. If that signal appears, the story gets stronger. If it does not, the current read can fade quickly. The next clean read on 1.4B flows crypto is not a louder slogan. It is whether the next measurable step confirms the same pressure, demand, or trust signal that made this headline matter in the first place.